Welcome to Bitcoin and Crypto Demystified. I'm Simon Lambert of This Is Money, and I'm delighted to say that joining me in the studio I have Glen Goodman, the best-selling author of The Crypto Trader, and Simon Peters, crypto analyst at eToro. For the next 45 minutes or so, we're going to be talking all things crypto, from how Bitcoin emerged to why rivals were launched, the merits of altcoins such as Ethereum, Cardano, the rise of meme coins, and also how the blockchain works and why people are excited about decentralized finance. My two guests are going to answer some of your crypto questions that have been sent in with the aim of helping those investing or thinking about doing so to be better informed investors. But first, before we get started, a caveat. None of today's discussion constitutes investing or trading advice. If you do decide to buy crypto, do your own research and be fully aware of the risks. Crypto is fascinating, but it is unregulated and unprotected, and it can be the Wild West of the financial system. Prices are highly volatile, and that means you can lose money fast. Even Bitcoin, the most famous crypto, has managed to double, halve, and then more than double again this year alone. Investing in anything high risk should only be done with a small and manageable part of a properly diversified portfolio. And remember the FCA's warning. Those investing in crypto should be prepared for the risk that they lose all their money. So, warning done, let's get started by finding out a little bit more about our guests. Glen, you are the author of The Crypto Trader. Tell us, how did you get interested in crypto? Because you also trade stocks and shares as well, don't you?
Yeah, I'd been trading for a long time already before I even touched on Bitcoin. So I'd been doing stocks, commodities, and Forex, and treasuries, and basically trading just about everything for years and years. At the same time, I was a TV reporter, so it was kind of a hobby for a while. Then I decided to make it full-time when I started making enough money trading, well, more money trading than I was making for my salary. So I thought, okay, I'll jack in this TV reporting lark and just do trading. And Bitcoin already existed by that point, because that was kind of 2012. But then it was thought of as a bit of a joke. And then there were some really, really major problems with it. In 2013, 2014, Mt. Gox, the world's biggest crypto exchange, was robbed and basically fell to pieces, and tons of people lost tons of money, and it was all a big disaster. And so as a result of that, the thing was, as the price plummeted after that, it started recovering, and as somebody with a trader's mentality, I was perfectly willing to put some money back into it, but I was fully aware that putting in too much money would at that point be like handing over cash in return for a handful of magic beans. You know, that's kind of how it was seen at the time, and it's easy to forget that now that it's like bigger than $1 trillion asset. You know, people think, well, you can't lose your money with Bitcoin. Back then, nobody was saying that, put it that way. But I got interested through that, started trading some Bitcoin, but it was only really when Ethereum came along that suddenly a little light bulb went off above my head, and I thought this could be a really big deal. I'm actually, to be honest, slightly surprised that Bitcoin is still the big daddy, because I would have thought Ethereum would have topped it a while ago. That's just my personal opinion, but it was Ethereum that got me excited.
Okay, well, we're going to move on to Bitcoin and Ethereum and the altcoins in a bit, and I'm going to get you to help explain that. So you set yourself up for that now.
Okay.
Simon, you're a crypto analyst.
Yeah.
What does a crypto analyst do, and how did you get interested?
Well, I really got into, I've been similar to Glenn, I've been trading for about 10 years now. So stock, shares, FX. I actually got into eToro, crypto, sorry, when I joined eToro, but I'd heard about Bitcoin a few years before that, and I at the time didn't quite understand the concept of digital cash, and there's no central authority or bank that actually is there to facilitate the payments. I didn't quite understand that, and perhaps at that time didn't really look into it deeply. But really, when I joined eToro, that's where my interest grew. We've had it on the platform for a number of years before I joined, so I've been in the company for 5 years now. So it's been on the platform for about 8 or so, and we've expanded the offering to about 40 now. Yeah, so that's where my interest has really come from.
Okay, well, we are going to go straight to a question from a reader, and you'll understand why here. Glenn, I'm going to come to you first. My question is pretty simple. What is Bitcoin? I have absolutely no idea what it is or how it works. So we're starting with the basics here, but I think this is something that actually for a lot of people who are looking at crypto and going, this is a thing. This isn't going away. I may not want to put all my money into it. You certainly shouldn't put all your money into it, but I do want to understand how it works. What are the basics there?
I mean, I hate this question because I'm always searching for the perfect analogy. And because Bitcoin is kind of unique, or certainly it was unique when it was invented, it's quite hard to compare it directly with anything else. But I'd say the nearest analogy that I like is in-game currencies, like V-Bucks in Fortnite and Robux in the very, very popular kids game Roblox. Anybody who has kids who play these games, or any kids who do play these games, instinctively kind of now understand that these currencies have value. The value is put on by the companies that have invented the currency, but nonetheless, like Bitcoin, they don't exist as physical things in real life. And actually, the money that we use every day, the pounds that we use every day, we don't use a lot of cash these days. Most of our transactions, all of us here, and everybody watching, it's just bank movements from one bank to another. You know, we buy something online, the money goes from there to there. You know, that's how most of our stuff, including grocery shopping for many of us, is done these days. And that means that there's no actual physical money ever existing in that process. It never really exists at all. That's what people don't truly understand, is that only about 3% of the total money in our economy is actual notes and coins. The other 97% or so is just bank transfers, where we buy something online and it goes from our bank to someone else's bank. So Bitcoin isn't that different in that regard. And like I say, you've also got in-game currencies which are invented by corporations. The difference with Bitcoin is that no corporation is behind it. This is the bit that often confuses people, because it's like, how can nobody be running it? Who's running it? A computer program is running it, you know, which is kind of scary thought in itself, in a way, like if it became the currency of the world. And I think it is mildly possible. It's just about possible Bitcoin could become like the main global currency. If that happens, then, you know, there will effectively be a computer program running the entire global financial system. But the beauty of the program that the mysterious Satoshi Nakamoto, who nobody knows who he is, the beauty of the thing that he made up is that it's possible for it to run entirely on its own, with incentivized players like miners, who you've probably heard about, and the people buying and selling the stuff, and all the other services that attach to it are kind of, they're just slaves to the code. The code is what dictates who does what.
And what's the blockchain element of it?
Well, that's the technology that underpins Bitcoin. So just to expand on what Glenn was saying there, so with these transactions that are happening across the network, they are stored on the blockchain. That essentially is the decentralized ledger, which holds all the transactions, keeps accountability of what each person has in their Bitcoin wallet. It's called the blockchain. Essentially what happens, to put it in a simple way, all of the transactions are put into a block. And then that block is what is hashed, is one of the technical terms used, and the hash of the previous block is then put into the next block to be added to the blockchain. So that's how the blocks are linked together through this hashing algorithm, and that being included in the following block to be added, hence the term blockchain. But essentially it's just the technology that underpins Bitcoin, which holds all the transactions, to put it simply.
And that's the same technology, Glenn, that underpins other cryptocurrencies as well. You mentioned Ethereum earlier. So for people who don't quite get the difference, don't quite understand, what is the difference between Ethereum and Bitcoin? And is Ethereum even really a currency? We talk about it as a cryptocurrency, but is it more of a platform?
Yeah, I mean, well, it is a currency and it's also a platform. That's why I got so excited when I first heard about it, when it first came along, because it was just such a piece of genius. Well, Bitcoin was a piece of genius, but this just really captured my imagination. And actually, just to add to what Simon was saying there isn't, of course, just one blockchain. There are loads of blockchains. Bitcoin was the original blockchain. Ethereum has its own blockchain. Lots of other cryptocurrencies have their blockchains. And like Simon was saying, they're just digital ledgers. So it's just, you know, like you would have a database full of transactions for a bank, say. This is kind of the same kind of thing, but it's distributed. In other words, it's, no one company, no one bank is in control of this list of transactions. It's sort of spread around
This idea of decentralization.
Yes,
Yeah.
exactly. It's spread around thousands and thousands of different computers. Decentralized makes it much, much more secure, much harder to hack. Well, Bitcoin itself has never been hacked. Lots of, like I said, the big exchange was hacked, but all this kind of infrastructure that's bolted onto Bitcoin, a lot of that can be hacked. But Bitcoin, the blockchain itself, very, very difficult, almost impossible to hack. So Ethereum is better, I think, because not only is it a currency like Bitcoin, so it does pretty much everything that Bitcoin can do, but on top of that, it was originally, when it came along, known as the world computer. That phrase seems to have disappeared somewhat, but it still kind of is that. It's a whole new operating system. It's like the Windows operating system or something, and then you can build apps on top of it, just like people build programs on top of Windows, all the programs we use on our computers. So Ethereum is kind of like that. You can build a whole ton of a whole world of crypto-based applications on top of it. It opened up the possibilities to make huge changes to the world. And here's the crucial point that I would like people to get into their heads about crypto in general, is that get away from the whole currency thing for a minute and think about it as a new technology, blockchain distributed ledger technology, which allows you to disintermediate the middlemen in many, many industries. That's really what it's all about. And that's what got me excited about Ethereum and the apps that can be built on Ethereum, is that hopefully we can save tons of money by scrapping entire industries that currently exist. People will lose their jobs one day, but they will find other jobs. That's the way the world works. Creative destruction. Things will be destroyed and more efficient things grow in their place. That's the dream of cryptocurrency.
And Simon, there are other. There's many cryptos, aren't there? What are the other main sort of rival altcoins to?
Yeah, so you use the term altcoins, which is essentially anything other than Bitcoin. So we talked about Ethereum. One of the altcoins that's got a lot of publicity in recent times is Dogecoin. But essentially, Bitcoin is open source, so you can go online and you can see the code, and you can make if you're part of the Bitcoin community, you can make proposals to modify and provide enhancements. But you can also essentially copy and paste the code and create your own crypto from that. And we've seen that happen with the likes of Litecoin, for example. But also, if there's disagreements within the communities as well, then we see forks happen. Most notably, back in 2017, there's a disagreement in the Bitcoin community, which resulted in Bitcoin as we know it today, Bitcoin Core, Bitcoin as we know it today, and Bitcoin Cash. So there's actually a new cryptocurrency created from a disagreement within the original Bitcoin community. So that's how it happens. Yeah.
And we've seen more and more of these sort of emerge. Some of them you talked about Dogecoin, and we're going to talk about the meme coins a bit later. But there's also new ones emerging that are much more serious, and people suddenly to get very interested in things like Cardano and Solano and things like that. Are you seeing from people who are using your platform lots more interest in some of those?
Certainly, yeah. I think with you mentioned like Cardano, Solana. So with crypto as well. Not every crypto is a cryptocurrency. Not every crypto is a coin. Some are tokens. So there are sort of different cryptos within crypto, so to speak. So with cryptos that are coins, these are sort of native to their own blockchain, like Ethereum, like Solana. We have some cryptos that are built on platforms, and their tokens. Like, for example, there's decentralized exchanges which build on Ethereum. Glenn mentioned about building applications on Ethereum, and each of these applications has its own token to facilitate, whatever it is the application is designed to do. So there's coins, there's tokens, there's cryptocurrencies, utility coins, tokens. There's a whole basket that people can get exposure to.
Okay, and to go back to a read question here. I get the idea of crypto providing a universal global ledger without the need for a state banking system. However, what is the value of any crypto actually based upon in the real world? Does a crypto have an intrinsic value? Is that an impossible question?
It's mainly thin air. Here's the problem with valuing them, and I go through this in my book, like an entire chapter talking about, right, here's how fundamental value can be attempted to be put on these cryptocurrencies, and I go through all the theories, and then I kind of go, But it's not really quite right. It's not really working, is it? Because the thing is, when you've got stocks and shares, you've got profits and revenues. It's as simple as that. That's what you base your fundamentals on, or cash flow, things like that. Whereas with cryptocurrencies, you don't have companies with profits and revenues, or if you do, they're not directly connected to the value of the cryptocurrency itself. And this is a real problem, and this is why you get these extreme volatile cryptocurrencies that rise several 100% and then fall. I mean, look, people forget in the 2018-2019 bear market, most cryptocurrencies fell like 95%. Some of them fell 99%. Some of them ceased to exist altogether. Even Bitcoin fell 85%, and that was like the most solid of them all. The problem is that this is how I see it. They're basically tech startups, right? And if you had a tech startup which didn't really have a proper product yet and hardly anyone was using it, then you might value it at a few $1 million. A VC, a venture capitalist, might value it at a few $1 million. But we've got projects on that level, thousands of them, that are about on that level that I just mentioned, and they're worth hundreds of millions or billions in the crypto market. So these valuations are way out of proportion to what a typical tech startup would be. And that is a significant problem for a trader like me, because I can't take seriously the possibility that they're only going to go up from now on, or maybe just like fall a little bit from time to time. I think there will continue to be huge bear markets of the type that we've seen in the past because of the difficulty with putting fundamental valuations on. There's no floor to the prices of these things.
And I think, for us, we have always taken, This Is Money, we've always taken a very open-minded but healthily sceptical, I would describe it as, view of crypto. And many of our readers, might have a little bit of crypto. They might just be thinking, maybe I want to get some. But it's kind of explaining to them the thing where it is highly volatile, and even if something that is highly volatile is only a very small amount of your portfolio, that can quite dramatically change the returns. Now, it can change the returns very nicely, and you're sitting there going, well, I pat myself on the back for investing in this. Or it can change them quite dramatically in the opposite direction, and if you get in at the top and then something crashes, you have a problem. And just like we say to people when they're investing in shares, if they're building a portfolio of shares, you need a diversified portfolio. There's been academic research done on it. You need about 15 to 20 different stocks to start having that proper level of diversification.
Yeah.
But they need to be 15 to 20 companies that don't all do the same thing, or are not all affected by the exact same movements in the market. And that's the difficulty for someone who's going, right, I'm going to build a portfolio of cryptocurrencies, is that when the crypto market rises or falls, it tends to be the tide, rises and falls all at the same time, potentially by different amounts, but that it's not diversification if you just invest in lots of stuff that does the same thing.
The trouble is that you have that with stocks as well to some degree, and people forget about that in the periods in between the sort of, every 10 years ago we get a massive, every 10 years or so rather, we get a massive crash, and people forget in the sort of 10 years in between, and a lot of financial advisors, actually IFAs even forget that in between. Like you say, there's a lot of talk of diversification, but when the big crash comes every decade or so in stocks, and much more often in cryptos, maybe every few years or so, then everything falls at the same time. The whole lot kind of goes down together. It's a problem.
Yeah, I think also it's such a new technology as well. It's just trying to figure out what direction to take, and that's perhaps one of the reasons why it does rise and fall at the same time. But I feel over time we'll see a lot more diversification in crypto, certainly.
And if you're trading, volatility can be your friend. I mean, that's the thing that makes markets move and means that there are the opportunities to get in and get out. But that requires rules, doesn't it? And you have to stick by your rules. It's not just I'm just going to take a punt on this. So tell us a little bit about your trading, Glenn, and sort of what you do and how you do it, kind of thing.
Okay, well, I try not to be too short term, but that's my choice. I mean, if people want to do shorter term trading with cryptos, by all means do it. In my experience, shorter term traders, apart from very few, tend to lose money eventually. Longer term traders and investors tend to do better. My best trades in crypto have certainly been the longer term ones, where I've made 50 times 100 times my initial investment. Those are the best ones, obviously, whereas, the shorter term trades are harder to get right because of the wild swings in price. The most important thing, as far as my book is concerned, is the two main rules for professional traders in Wall Street since forever, which are run your profits and cut your losses. The most important of those is cut your losses. In other words, if you're losing on something, it's best just to get out. You can always get back in later if you realize you're wrong, maybe at the same price that you got out. But the point is that it goes for stocks, it goes for commodities, it goes for everything. When you're on to a real loser, just accept that it's a loser, because especially in crypto, that loser might just go to zero. It might just turn out to be a load of old rubbish that nobody's interested in ever again. I mean, that's less the case with Bitcoin, which will probably persist for years and years, and the same with Ethereum. But for most other cryptos, they go in and out of fashion. Everyone's talking about Solana and Cardano now, but 3 years ago, they were talking about completely different cryptos, which nobody even mentions now, half the ones that we were banging on about as like the big ones of the future a few years ago. It's so much down to fashion in the crypto world. There are so many projects that do similar things to each other, and it's kind of anybody's guess which one of those will win out in the long term. So yeah, I'm pretty skeptical when it comes to fundamental analysis in cryptos, looking at the quality of a project and going, yes, this one will almost certainly succeed in the future. If you see a good project, great, and that's another reason to invest in it, but it can't be the only reason, because the public and their whims determine what will happen in the long run. And like, for an old example, like VHS beat Betamax in the consumer, God, that's an old example, but it's like Betamax was the superior technology, beta tapes, but VHS cassette tapes won and just dominated the whole market, even though they were terrible quality. Stuff like that happens in the world of technology all the time.
You're right, it does. Personally, I always thought mini discs were pretty good. But
Yeah.
The rest of the world decided that they weren't, didn't they? So
exactly.
Yeah. Simon, you mentioned earlier about the meme coins, and seeing as we're talking about the fads and coins here and what's in fashion at a certain moment.
Yeah.
Over the past year or so, the meme coins have really become a big thing. We've seen Dogecoin, we've seen Shiba Inu, which is an offshoot of that. Can you explain a little bit more about meme coins, what they are and what's
happening? So I think with meme coins, they're generated from, as you said, a meme, maybe start as a bit of a joke, like Dogecoin, for example. That's the original meme coin. But at the same time, they do bring attention to the crypto space, and I'd hope that that encourages people to actually explore crypto, understand it a bit more. But there's communities behind them as well, and the growing communities. And we are seeing nowadays that communities do have an effect, and getting these coins to become really adopted in the world.
Well, people beware the tweets from a certain person as well. Yeah, indeed. Glenn, going back to some of our reader questions. I've got a question here. Should any crypto assets be moved from an exchange into a separate wallet, or is it safe to leave them where they are?
It's not safe to leave them where they are, but you might consider that it's safe enough. I generally suggest when people write to me about this, I say it's up to you, because if you transfer them to a separate wallet, particularly a physical wallet, which is basically a USB stick, a special kind of USB stick that you can take out of your computer, and then it's not connected to the internet, and everything's wonderful. But it's a lot of hassle doing that if you're trading quite regularly. If you're investing very rarely, then that's something that you should consider doing, certainly. If you're trading really regularly, a lot of people leave their cryptos on exchanges, in the wallets on exchanges like Coinbase and like eToro, who Simon works for. And, as long as those companies don't go bust, then you're all right. If they do go bust, then it's anybody's guess whether you'll get any of your money back. It's not protected by the Financial Services Compensation Scheme, which covers a lot of investments in this country for up to £85,000 of losses. It wouldn't be covered by that because crypto is not regulated in that way in this country, in the UK. So it's, you're taking a risk. But, I take that risk. with some of my money, not a great deal of my money at any one time, because it's whatever you feel comfortable with losing in unlikely circumstances. Just imagine, how much money do I feel comfortable with the small risk of completely losing? That's the question.
Yeah. So maybe just to expand on that. So with investing into crypto, you mentioned exchanges, but I'd say to invest with reputable exchanges. Generally, reputable exchanges would employ what's known as cold storage, so keeping crypto offline, but also keeping assets segregated as well. So if there was a situation where, heaven forbid, a company was to go into liquidation, administration, whatever it may be, then the asset should just be able to be distributed back to the persons attributed to those records, if that makes sense. So, but you do have the option to move the crypto yourself and be your own custodian. However, being your own custodian, you are that. If you lose your USB device, wherever you're holding your private keys, then that's it. It's gone forever.
We've all read those stories, haven't we? If you
Yes.
can't find the key, it's been thrown
away.
away.
It's about weighing up which option's best for you. Whether you feel more comfortable someone else looking after your crypto being custodian, or whether you feel more comfortable being yourself the custodian.
Yeah, it's a good point, because people do lose those things probably far more often than people actually lose money through being hacked on exchanges. So like a huge amount of the Bitcoin that exists has actually disappeared off the face of the earth because people have lost it over the years and blah, blah, blah. So yeah, that's actually a really good point by Simon. It's like, who would you rather blame if you lost your money? A faceless exchange, someone who steals all the money and runs off to Bermuda, or yourself for having lost the thing?
And as crypto is becoming more mainstream and more big business, I suppose, is that relationship between, exchanges and wallets and platforms and where you would keep it getting closer and closer together? Whereas in the earlier days, it would have been you went to an exchange, you put it in a wallet. Whereas now there's more companies that are offering, a range of things.
Yeah, there's certainly more on-ramps to get into the crypto ecosystem, but there's also another avenue with decentralized exchanges where you can buy and sell tokens, not for a centralized exchange, like a company that has an image or a face. It's all online or on a platform. So that's a different aspect completely. And in that world as well, it has or lacks the oversight that we have with centralized exchanges, because with centralized exchanges they can employ KYC and appropriate measures and processes. With decentralized exchanges, it's just that it's open to anyone to be able to create these pools where people can buy and sell, and that does open up the ability for bad actors to get involved in the space as well.
The risk of not knowing who you're dealing with, kind of thing. Yeah.
Actually, that's a really important topic. The decentralized exchanges. You might have heard of DeFi, the decentralized finance industry that involves, it's kind of like peer-to-peer lending, basically, which has existed in this country but never really took off in a big way for about the past 15 years or so, with companies like Zopa. And the idea is it's just sort of cutting out the middleman, and it's normal people lending money to other normal people, but it's all kind of put into a big pot, and then it's spliced up in terms of degree of risk and this kind of thing. So it's more complicated than that. But the basic principle is one person lending to another person. And there's this whole crypto-based DeFi industry that has grown up, including the decentralized exchanges that Simon referred to there. And there are a lot of regulatory issues around that. But it also could, when I said earlier about how the big dream of cryptocurrency is to cut out the middleman and save us all tons of money because those middlemen take so much money. Well, this is a big part of that, and this gets me very excited. Only in a platonic way.
But this is where people are talking about the future of finance and perhaps even the future of the internet.
Exactly. Like, here's a perfect example that I was reading about today. Well, I read about it about 6 months ago, but I was hoping that there'd been some update. There hasn't been. But it's still exciting that about 6 months ago, an Australian guy managed to refinance his mortgage entirely using decentralized finance, right? And now there is a company working on trying to develop just that, and has been working on it for about 6 months or so as well. And I'm really hopeful that if that company comes to something, great, but if not, somebody else will do it. But the idea is perfect. The idea that you wouldn't need mortgage providers anymore. You would simply say, I need, I've bought this house, I want to buy this house, and it's £500,000. I need to borrow £250,000. Can I do that, please? I'm putting up the first quarter myself. And of course, you would need to put up the house as collateral. So the house would be tokenized. It would be turned into there would be a token invented that would represent the house. And then that would be put up as collateral. And then you would be lent by the community, the DeFi community, the £250,000 that you need. And you would pay a certain amount of interest per year in exactly the normal way. The difference being, there's no bank in the middle there. There's no building society. There's no billions of pounds of profits for these banks every year, because it would all just be going from community members to other community members. It's like a little utopia if it works.
And the idea is that this would succeed because of that element of the blockchain, the ledger in there, and also smart contracts. Is that right as well?
Yes.
So, and the idea behind a smart contract, what is that?
It's just a piece of computer code. So it's like, you would hand over the token that represents the collateral, the house collateral, and they would hand over the money, and they would both be governed by a contract, which is just a bit of code that says, if you fail to make your mortgage payments, then this token that's worth the value of the house will go to the people who lent you the money. It's that kind of thing. It's just, it's code, contracts.
Yeah, simple as that, just code built on pre-written instructions. Yeah.
So to go back to another reader question, here's a tricky one. Could you envisage a scenario where Bitcoin went to zero?
Well, I answered the last one, so...
Yeah, no, I mean, theoretically it's possible. But at this moment in time, I don't see it happening. We're at a point in time where Bitcoin's legal tender in certain countries, and over the years to come, I see that expanding to more countries as well. We're seeing, from an institutional point of view as well, them looking to get exposure to the crypto world. So, no, at this moment in time, I don't see it happening, to answer the question, no.
Yeah, I mean, it's possible, but highly unlikely, I think.
It's at the level of adoption now where it could crash to a very low level, but you would find a floor where people would then start.
Well, look, again, in my book, in The Crypto Trader, I go through a whole bunch of scenarios where people never dreamt in a million years that something could go to zero, or not go to zero, but something could collapse and become almost worthless. But it just happens all the time. It's just we kind of forget about it. The first example that pops in my head is BlackBerry, right? Remember Crackberry? Remember how everybody had a BlackBerry and it was like, yeah, everyone's got a BlackBerry. Oh my God, I'm obsessed with my Crackberry. And then within a couple of years, just no more. Nobody had BlackBerries anymore. And the company's share price just absolutely plummeted. Okay, it didn't go to absolute zero. But, I mean, that's just one of many examples. Nokia is another one. Nokia ruled the world in terms of mobile phones. Then out comes the iPhone. Nokia is practically finished. And, again, it's kind of back on. I've actually got a Nokia phone now. It's back on its feet. One of those sort of more modern ones. But, it's not the giant it once was, let's face it.
And to go to another question here from a reader, I wanted to ask the panel's opinion on how they see true cryptocurrencies, coins used as a form of digital cash, shaping up in modern society. Do you think there will be widespread adoption across both businesses and consumers, or do you think they will end up having niche uses, such as in gaming microtransactions or for B2B payments? Are we going to end up spending crypto when we're doing our everyday spending? And how does that feed into the thing we hear talk about of central banks wanting to start their own cryptocurrencies? Simon?
Yeah, so I think there's a lot of components to your question there, but to go to the point about adoption of crypto as currency, as I mentioned, we're already seeing it happening. What I would say with Bitcoin, certainly, it needs to. There's an issue around scalability. With Bitcoin, its original design, there's a limitation on the amount of transactions it can do per second, and that limitation is not where it needs to be in terms of being a real global currency. However, there are solutions that are being built on top of Bitcoin, layer 2 solutions, which are working to overcome that. So over time, that will happen. And the idea, just go back to the point about transaction fees and cutting out the middleman, that's what it's about. Instant transactions, real-time settlement with minimal fees. And where we're using digital payments at the minute through certain networks, the merchants are being charged a percentage on each transaction that they're doing. If they can to accept crypto, they can minimize that cost, so to speak. So I see it more from a merchant point of view, that they could enforce adoption and promote the acceptance of crypto from their side, rather than the other way around, consumers wanting to pay in crypto.
And Glenn, I mean, in terms of spending crypto, as Simon said, Bitcoin isn't actually the easiest thing for people to to use as a currency. But there are others that have been created with the idea that they'd be much easier and less friction to use as a currency. But there is the concern about, obviously, there's environmental concerns as well, isn't there? That it's quite energy intensive. Can you see us just spending crypto rather than spending pounds, or is the Bank of England going to get in there first with Bitcoin?
Yeah, the Bank of England will. And I mean, China already has its own digital yuan now. It's tried it out. It's been testing it across numerous cities. Many thousands of people have been using it. The feedback is not entirely positive. The problem with centralized central bank digital currencies, the problem for us in the West is that it's a wonderful surveillance tool. And this is going to scare a lot of people, and it should scare a lot of people, because in China, they will be using it to surveil. And they make, no bones about that. In the West, you could say, well, we can trust our governments. Look, I can't even say that with a serious face. But the point is that central bank digital currencies, all digital currencies are programmable money, right? That's the element that they have that makes them different from just bank-to-bank transfers of the kind that I was talking about earlier using pounds, is that each individual unit of the currency can be programmed. So say in China, let's take a hypothetical example. Say you have a political dissident who doesn't agree with the Chinese government and sometimes says things that make them feel a little bit uncomfortable. What they could do with the digital currency, if all the money was just digital yuan, which it may well be in the future, then what they could do with him is say, we are going to allow you to eat some food. You can spend those coins there on some food, but that's all. All your other money is going to be either switched off, or we're going to allow it only to be spent on certain things, like, we'll put this amount aside for your rent, that kind of thing. You can micromanage literally every unit of the currency, and whether it works, whether it doesn't work, what it can be spent on, what it can't be spent on. And let's take a really dystopian example for the UK, which I discussed on LBC recently. I came up with a possibility that scared the presenter of, let's say a prime minister in this country was so worried about the obesity crisis that they decided, under a digital Brit coin or whatever, that people were no longer allowed to spend their money on junk food. Or let's say they just allow you to spend only a bit of it on junk food. A lot of people in this country would go along with that, I reckon. They go, yes, that sounds like a sensible move. Okay, we'll agree to that. You're only allowed to spend, 1% maximum of your weekly paycheck on junk food. If you try and spend any more than that, the money literally won't work. It will have been switched off for that purpose.
And I mean, that also feeds in a less dystopian way into the ideas of for central bankers, certainly in the West, who've been indulged in some fairly extreme monetary policy in recent years, quantitative easing and money printing, etc. The idea of potentially being able to time limit money, so you could use it as monetary stimulus. You could give it to people, but they got to spend it within a certain period of time, otherwise it's gone. And that's a way of kind of stimulating the economy.
Yeah, I mean, I think COVID was an example of getting stimulus to citizens. I think in the US, they're still having to get checks posted out to them, whereas if they had a central bank digital currency, they can, and a Federal Reserve wallet, wherever it may be, they can easily just transfer that value across to citizens and not have to go through that process. But as Glenn mentioned, with CBDCs, although they're inspired by Bitcoin and other distributed ledger technologies like that, by design may be highly centralized, and that in turn could push people towards cryptos like Bitcoin.
It could, unless they ban it. They're never going to be able to 100% ban Bitcoin because it runs, decentralized, blah, blah, blah. But, the big fear at the back of the heads of most Bitcoiners is the possibility that they could turn off the off ramps, like eToro.
Well, we've seen it in China, for example. There were a big crackdown on miners in China, so they banned mining of Bitcoin, but they also banned transactions, effectively shutting off Bitcoin to a large proportion of the world's population. So yeah, that is one of the risks, I suppose, with governments.
And that's why the ETF, the SEC, regulating the ETF in the US was seen as such a positive for crypto, wasn't it? Because it sort of brings it within the official world of finance, And there may be lots of people who are investing in cryptos already who think, well, I'm not investing in cryptos because I want to buy an ETF. But there are lots of people who invest in other things who think, I would maybe like to invest in a bit of crypto, but I'd like it to be within a more regulated and protected scenario.
Yeah.
And if there is an ETF on offer to me, then I would see that as a positive.
Yeah, I think the US government, because it will be the US government if any government's going to do this. They're always in charge of everything in the world generally. So I think if anyone's going to do it, it'll be the US government, and they're running out of time because, as you say, it's becoming much more institutionalized now. You've got big, not necessarily the biggest financial institutions spending a lot of money on investing in Bitcoin for their clients, but certainly the sort of mid-ranking ones are getting more into that kind of thing through the ETFs and so on. So, there'll come a point where if they do try to kind of outlaw Bitcoin by stopping people from converting dollars into Bitcoin, which would probably crash the price and make it a sort of a sideshow, an obscure thing. If they want to do that, they need to do it quite soon, because otherwise they're going to have big banks at the banging on their door going, how dare you crash our investments like this? And the US government doesn't like to annoy the big banks.
So from one acronym to another, ETF to NFT, see how I did that segue there? Very good, yeah, indeed. Just give the magic away. Simon, what's an NFT?
NFT,
why have these become so popular?
Non-fungible token. So going back to the example that Glenn mentioned earlier about property and tokenizing assets. So that in effect is an NFT. It's a token that represents something that is original, essentially. With NFTs at the moment, I think they've been associated with like digital art and online videos, things like that. And it does take a little bit of time to get your head around, to be fair, to see where's the value in having the real digital art. But even though it can be replicated, but knowing that you are the original or the owner of the original piece, that's where the appeal is with NFTs. But it can be expanded to not just digital art and things like that, but we've seen recently with Dolce & Gabbana, they did a collection where they auctioned off digital pieces of clothing that you can wear potentially in the metaverse one day on your digital reputation of yourself. There's a whole world of possibilities where we could go with NFTs. Digital art is just one. Tokenization of assets, I feel, is the major step where NFTs will see the real benefit of NFTs.
Would you buy an NFT?
I would, yeah. It would have to be the right NFT, to be fair, where I'd see value in it. Go back to the Dolce & Gabbana example. I think that's fascinating to have virtual clothing to wear on your digital representation of yourself in the metaverse. So that's something that I find very interesting, and it has to be the right NFT to answer your question. Yeah.
Would you buy an NFT, Glenn?
I've been encouraged by some of the people who I chat to who've read my book and so on, who are really into that kind of thing. But the problem is it's a very enclosed, community-based little world, and it's kind of like the real world, art world. If I wanted to buy art for investment, I wouldn't know where to start in the real world. You have to be immersed in the whole kind of, which squiggly painting is the right squiggly painting. I mean, I don't know. And these people really know, because they spend all their time chatting on Discord and other apps to find out, where people see the value in the future. The problem is, look, I'm kind of skirting around the issue here, which is that there are Ponzi scheme elements to it. Let's not pretend there aren't, because some of these pieces of digital artwork have sold for millions and millions of dollars. The most famous one, I think, sold for $68 million for Beeple's work. And Beeple, he did some great digital art. I'm not taking anything away from him. It's wonderful. But $68 million? Seriously, for a guy who was completely unknown about 3 months earlier? It's just insane. And what's more, it's not an accident, okay? There are scams going on. Because this is an unregulated space, it's very easy to drag out the old book of scams from the olden days before regulation came into the mainstream markets and go, right, what can we do here? How can we rip people off? And in the NFT market, it's super easy because all you have to do is ramp up the prices by selling things to yourself, or rather you set up an account that is, actually yourself, but it's a separate account. It's like you're selling between different accounts. Do you see? So it's like, say you've got a piece of rubbish artwork you've just created, like a blank canvas with a dot in the middle of it. That's the kind of thing. And you then sell it to yourself for three grand, and then you sell it yourself, sells it to another new account that you've created yourself for 6 grand. And you keep doing this, and then one day you get the mark, the patsy, the victim,
The greater fool.
the greater fool, and you say to them, do you want to buy this for 100 grand? And they go, well, why is this dot worth 100 grand? And you say, well, look at this chain of transactions in the past between all these different people. They've been, it's like a bidding war for it. It's going crazy. And that kind of thing is happening right now in the NFT market. There are loads and loads of recorded cases already of it happening. So I'm not saying the whole thing is a Ponzi scheme, but there are Ponzi scheme elements out there. And you've got to really have super confidence that these things are going to keep their value. Like the apes that are very popular in the NFT world are, they seem to be amongst the bedrock items, right? So you could argue, okay, the apes will never lose their value, at least because they're so popular. And maybe that's the case. It's kind of like baseball cards in the old days or something. Some things really do hold their value, or stamps like the penny black. Some of them do hold their value, but when things go out of fashion, a lot of them, like in the stamp world, a lot of them just, they lose their value. You have to really be so ensconced in that world to understand what to buy.
You could definitely see why people are excited about having that sort of ledger of transactions and provenance and taking it across into the actual physical world of things like art and classic cars and wine and things like that. And that's a kind of an example where you find this decentralized digital world start to meet the physical world.
Yes.
Yeah. Well, gentlemen, that's all we've got time for. Thank you very much for joining us. Thank you very much for watching. We hope you've enjoyed it. It was a real pleasure having you on. And
It was fun.
Thank you.
See you next time. Goodbye.